So James, no surprise, Bank of Canada left rates unchanged as expected. Did anything in the language change for you today?
Yeah, so the Bank of Canada was definitely more upbeat in this statement relative to the last time that we heard from them. And rightly so. The economic data have been quite more robust than they have been in the past, and that surprised a lot of us. When we look at the Canadian economy as a whole, we have an unemployment rate at historic lows. That means a lot of Canadians have jobs, their wages are rising, and that gives them more income to spend, really. And so when we think about economic growth around 1 to 2%, inflation at target, which is 2% for the Bank of Canada, the Canadian economy has been more resilient, and the Bank of Canada is recognizing that in this statement.
And do you think the Canadian economy can maintain that sort of positive level of economic growth going forward? Yeah,
so everything I mentioned is what has happened, and what that does is it puts us on more firmer footing than we thought we would have been in the past. But the trade risks that are out there, the political risks, they're very present, and we think they're probably going to remain in the next little while. And so what that means is that there's not that much cushion at 1 to 2% growth for the Canadian economy. So in the event of an economic shock or a further escalation, you don't really have much tolerance for the Bank of Canada to avoid cutting rates. So we would expect a little bit of this to start playing out in 2020.
James, you mentioned the risk of US-China trade. What are some of the other risks to the bank's outlook going forward?
Yeah, so the biggest risk that the Bank of Canada has mentioned and is mentioning today is housing risk. And we know about the high levels of household indebtedness. Interestingly enough, a lot of the positive growth that we've seen in Canada over the last little while has been due to the fact that the Federal Reserve cut interest rates, and that has reduced global interest rates, which has fed through to Canada. So our mortgage rates came down, which made housing more affordable, which increased the number of sales in Canada, which helped out GDP growth. So if you have a situation where if rates rise, if we have a global economy that improves from here, rates rise and that has an impact on housing, that could be a risk.
Given all the risks out there, where do you see the loonie going forward?
So the loonie is caught between two interesting forces right now. In one sense, on the interest rate side, in Canada we have higher policy rates than in the United States because the Bank of Canada hasn't cut, but the Federal Reserve has cut. And so what that generally means is that investors from around the world are going to want to capture some of that return by buying Canadian bonds. And so that's favorable for the loonie. But on the other side, because we know we are in a situation of lower global growth, that means less demand for our commodities or our exports. And so you have that as another negative factor for the loonie. And so as a result, the loonie has been trading in this mid-75 US cent range for quite a while. And honestly, we don't think this is going to move too much from that range right now.
James, thank you very much for your time.
Thank you.